October 19th, 1987. In a single trading session, the Dow Jones lost 22.6% of its value, a deeper collapse than even the worst day of 1929. And yet, no banks failed, no central bank intervened, and within months the markets had not only recovered, but roared ahead. On the surface, it looked like a modern miracle. In fact, it was something else, because behind that day, now known as Black Monday, a rule was born. A belief disguised as a safeguard that automated shutdowns, known as circuit breakers, could prevent future crashes. The logic was elegant. If fear spreads faster than information, then slow everything down, halt the market, pause trading, let rationality return. But here's the paradox. The more faith investors placed in the circuit breaker rule, the more fragile the system became. And now imagine, the same mechanism applied to a market 100 times faster, 1,000 times more entangled, and driven not by panic, but by algorithms. Today, more than 80% of daily trading volume comes from machines. Milliseconds decide outcomes. What happens when a system designed to pause humans confronts a market no longer run by them? What if Black Monday didn't end with a solution, but with a sedative? Some economists argue that the rule itself became a form of psychological infrastructure, like airbags that encourage riskier driving. It didn't eliminate the crash. It normalized the idea that one would come. And beneath this calm exterior, another question grows louder. Was 1987 a victory of regulation, or the first warning that market control is now an illusion? Because if the circuit breaker rule failed to prevent the next shock, it won't be the market that freezes. It will be trust. In 1987, global finance stood on a ledge it didn't fully understand. The Cold War was still warm. Japan was outgrowing everyone. And in New York, the heart of capitalism beat faster with each passing quarter. The Reagan administration had deregulated aggressively, Wall Street was electrified by mergers, debt finance takeovers, and a new generation of traders no longer wearing gray suits, but wielding models. Portfolio insurance was one of those models. It promised to protect large institutional investors from losses by selling stock index futures automatically when markets fell, a kind of financial airbag triggered by mathematics. On paper, it was a revelation. In practice, it was a blindfold. The Federal Reserve, under Alan Greenspan, had only recently taken the helm. The global financial system, post-Bretton Woods, was entering uncharted waters. Exchange rates floated, capital moved freely, and the Big Bang deregulation in London just a year earlier had created a 24-hour financial organism. Money never slept anymore. Meanwhile, computers were changing how trades were executed. No longer called in by voice, many were now routed electronically. It was faster, but colder. Behind the noise of bull markets, the system itself was changing its shape. But the change was invisible. Average investors believed markets were still driven by fundamentals, earnings, GDP, interest rates. Yet under the surface, something else was stirring. Automated decisions, programmed reactions, and financial products built on elegant math with fragile assumptions. Volatility had been low for years, too low. It fed an illusion that markets could be tamed by intelligence alone. And then, the convergence. Massive institutional portfolios using the same portfolio insurance strategies. Machines responding in near synchrony. A cascade, not of emotion, but of logic. It's important to understand this. Black Monday wasn't a failure of economics. It was a failure of structure. The structure of assumptions. The structure of timing. And perhaps the most dangerous structure of all, belief in control. Some observers saw it early. A few financial historians warned, the more you standardize responses, the more synchronized collapses become. But warnings are only useful if someone is listening. By October 1987, they weren't. What appeared to be a sudden shock had been quietly building, line by line, trade by trade. If this gave you a new angle on the past, let me know where you're tuning in from. It began, as many crises do, not with a catastrophe, but with a signal. In early October 1987, markets were already tense. Yields on 10-year treasuries had surged to nearly 10%. Inflation fears resurfaced. The U.S. trade deficit widened, raising concerns about the dollar's stability. Then came Friday, October 16th. A drop, sharp but not extraordinary. The Dow fell 4.6%. Nothing seemed broken, just bruised. But the mechanism had already been triggered. Portfolio insurance algorithms, designed to protect institutional holdings, quietly activated. As prices fell, they began selling stock index futures. The intention was noble, limit downside risk. The effect was not. Each wave of selling created pressure. That pressure lowered prices. And those lower prices triggered more selling. By Monday morning, the trap had been set. Before the opening bell, markets around the world had already begun to slide. London dropped. Hong Kong halted trading. Then, at 9:30 a.m. in New York, the spiral began. By 11 a.m., the Dow was down over 200 points. Trading desks scrambled to understand. Phones rang. Screens froze. But something strange happened. There was no single news event, no bombshell, no central bank announcement. The market was collapsing, on autopilot. Program after program sold futures. Liquidity evaporated. Floor traders couldn't keep up. Quotes became meaningless. Bids vanished. At 2 p.m., the real acceleration began. Sell orders outnumbered buy orders 50-1 in some securities. The S&P 500 futures market decoupled from the index itself. Arbitrage strategies failed. Some market makers simply walked away. By the closing bell at 4 p.m., the Dow had lost 508 points. That's 22.6% of total market value in one trading day. To grasp the scale, it was equivalent to erasing over $500 billion in market capitalization in less than 7 hours. But what truly shook the financial world wasn't the number, it was the revelation. The market had no floor. And now, the contradiction. The very tools designed to reduce risk had amplified it. Portfolio insurance didn't break the fall, it made the fall steeper. The system wasn't reacting to reality, it was reacting to itself. Feedback loops had replaced rational decision-making. And because so many institutional players use the same strategies, their defenses aligned, not against the crash, but with it. What does that mean? It means that on Black Monday, fear wasn't the virus, logic was. The market didn't crash because of irrationality. It crashed because too many rational agents made the same decision at the same time for the same reason. That's not chaos, that's synchronization. And in a synchronized system, protection becomes a vector of collapse. Some analysts called it a liquidity vacuum, others a mechanical panic. But the lesson was clear. The more standardized the defenses, the more predictable the failure. If this turned a headline into a pattern, tell me where you're watching from. To understand why Black Monday spiraled the way it did, we need to strip away the drama and examine the gears. Portfolio insurance was the centerpiece. At its core, it was an options-based strategy, but instead of using actual options, it used dynamic hedging. That meant selling index futures as the market declined, mimicking the protective payoff of a put option. In theory, it was brilliant. In practice, it created a feedback loop. When the market dropped by, say, 2%, portfolio insurance models would instruct funds to sell a fraction of their exposure in futures. If the market dropped again, sell more. The deeper the fall, the more aggressive the selling. Now multiply that by hundreds of institutional investors, all using similar models, reacting to the same price signals at roughly the same speed. This is where the system's vulnerability came into play. Imagine a crowded theater with only one exit. Now imagine everyone has a fire alarm calibrated to the same smoke threshold. One trigger, and they all run. That's what happened on October 19th. But the mechanics didn't stop there. The index futures markets, particularly the S&P 500 futures on the Chicago Mercantile Exchange, were the first to react. As these were sold off, the actual prices of underlying stocks in New York were expected to follow. Arbitrageurs typically close the gap between futures and spot prices, but not that day. The selling volume in futures became too large, too fast. Arbitrageurs couldn't keep up. Liquidity dried up. Some stepped back entirely. The spread between futures and the index widened. It became a disconnected system. The futures market was screaming, "Sell now." The equity market was gasping, "But to whom?" In parallel, another mechanism cracked: market makers. Normally, they absorb volatility, provide quotes, and create a buffer. but they are not infinite. On Black Monday, many stepped aside. Some refused to quote prices. Others quoted absurd spreads. And here's the paradox. Without liquidity, prices do not fall in steps. They fall in cliffs. Each trade became an act of free fall. The mechanisms weren't failing randomly, they were failing in sequence, like dominoes. Each one triggering the next, exactly as designed, but under conditions no one had tested in real time. Circuit breakers, the now famous safeguards, didn't exist yet. That came later. On October 19th, there were no pauses, no mandatory halts, no forced breathing space. Which leads us to the real insight. The collapse wasn't caused by panic, it was caused by design. A system built to be efficient had become dangerously recursive. And now consider this. Every mechanism functioned as intended, but not one of them considered what would happen if they all activated together. That's not a bug. That's a blind spot. And blind spots are how systems fail. The day after Black Monday, headlines read like obituaries. Markets in freefall, panic on Wall Street, a new 1929? But unlike 1929, no major banks collapsed, no breadlines formed. By year's end, the Dow had clawed back more than half its losses. To the public, it looked like a deep cut, not a fatal wound. But inside the system, something had shifted. The first consequence was psychological. Investors, from institutions to individuals, had seen the abyss. They now understood how quickly markets could disconnect from fundamentals. It wasn't earnings or geopolitics that moved prices that day. It was math. A second consequence, regulation. In early 1988, the SEC and the major exchanges began coordinating a series of reforms. Chief among them, the introduction of circuit breakers. The logic was simple. If markets fall too fast, stop them. For example, a 7% drop would now trigger a 15-minute halt. A 13% fall, another pause. A 20% crash, markets close for the day. It was a mechanical answer to a mechanical problem. But the third consequence, and perhaps the most lasting, was cultural. Trust in the invisible hand gave way to faith in the visible button. From that point forward, market participants began pricing in the idea of intervention. The notion that if volatility spiked or prices plunged, someone, somewhere, would step in. First it was circuit breakers. Later it became central banks. In short, the myth of self-correction died, and a new story took its place. That markets might not stabilize themselves, but could be stabilized. This shift had cascading effects. Hedge funds adjusted their risk models. Pension funds diversified into derivatives. Indexing grew, passive strategies expanded, and the correlation between markets increased. Complexity deepened. Interdependence grew. And something else happened, quietly. The very tools that had contributed to the 1987 collapse were not removed. They were refined, repackaged, scaled up. Portfolio insurance didn't disappear. It evolved into structured products, into volatility targeting, into algorithmic hedging. What had failed at one speed would now operate 1,000 times faster. The final consequence was structural amnesia. Because the economy didn't collapse, many chose to believe the system had passed the test. That Black Monday was a fluke, a one-off. But it wasn't. It was a preview of what happens when too many systems think alike, when protection becomes pressure, when logic overrides memory. The cost wasn't just the money lost that day. It was the confidence gained in the wrong lesson. And that kind of lesson doesn't fade. It compounds. Today's markets no longer blink. They calculate. More than 80% of trades in U.S. equities are executed by algorithms. Volatility is measured, priced, and even bought as a product. Entire hedge funds operate without a single human trader. The architecture is faster, the language is code, but the core assumptions, they've barely changed. Let's start here. Portfolio insurance in 1987 used futures to hedge. Today, volatility control strategies use real-time market signals to shift between risk assets and cash. Different tools, same reflex. Then it was sell as the market falls. Now it's de-risk as volatility rises. And when do all these models de-risk? At the same time. Sound familiar? The synchronized logic that triggered Black Monday now lives in volatility parity, risk parity portfolios, and target volatility funds. Take March 2020. The COVID shock hit. Markets plunged 30% in days. Within hours, algorithmic models began shedding risk. CTA funds dumped positions. Volatility targeting strategies cut exposure. The result? Accelerated selling, just like in '87. And what stepped in to stop it? Not circuit breakers, not portfolio hedging, the Federal Reserve. $1.5 trillion in repo operations, bond purchases, corporate credit facilities. What once was an emergency measure is now an expectation. Then it was called a market halt. Today, it's called a backstop. But the effect is the same. Interrupt the fall, inject confidence, pause the panic. Only now it's global, coordinated. The European Central Bank, the Bank of Japan, the People's Bank of China, they all play the same role. They are the new circuit breakers. And yet, the structure beneath them hasn't changed. It's become more fragile. Because fragility today doesn't mean weakness. It means tight coupling. A change in interest rates in Washington moves currencies in Brazil. A downgrade in one ETF sparks margin calls in another. Debt is no longer just borrowed capital. It's leverage embedded in every layer of the system. ETFs, derivatives, structured products, they all carry assumptions about liquidity, assumptions that hold until they don't. And when they fail, the logic is automatic, just like in 1987. The labels may have changed, but the mechanisms, they're not just still here, they've multiplied. Market halts, still in place, now adjusted to match daily volatility norms. Dynamic hedging, now driven by machine learning. Synchronized responses, accelerated by shared data and unified models. It's not history repeating, it's the same instrument played faster. And here's the irony. Every improvement, every safeguard, every automated protection has made the system more efficient and less resilient. Because resilience requires diversity of response, but in today's market, diversity has been engineered out. We don't just trade the same assets, we think the same way about risk. And when that thinking turns, the fall is instant.
So where does that leave us?
A rule born in 1987 still governs a market that no longer resembles the one it was built for. It was meant to calm traders. Now it reassures machines. It was designed to pause human fear. Now it interrupts algorithmic certainty. But here's the final paradox. The more we rely on these rules, the less we notice when the system outgrows them. Circuit breakers won't stop a crisis fueled by software. Interventions won't repair a structure shaped by identical thinking. And safeguards can't protect against the illusion of safety itself. This story didn't end. It simply changed form.